It's 5:02. I think we'll slowly get started, and then people keep trickling in. But I love doing these quarterly reports. We take some time to review market conditions, talk about the current, state of the market, talk about how our assets are performing and how we're pivoting. I think quite a bit has happened since the last time we did this, which I think was in the beginning of this year. So, I'm excited to deep dive. And then, as always, guys, as we go through this, feel free to drop your questions in the chat box, and I'm going to do my best to get to all of them towards the end of the meeting. But most of you know me, most of you I know really well, but some of you are new. And so I'll start off with a brief introduction. I'm Parambal Nipani. I'm a radiologist in Southern California. I built my real estate portfolio over 9 years, got a financial freedom, and then started building out the generational wealth MD community, and then GW Capital. And we're at this point a community of 9,000, mostly physicians and some other high income professionals. And the whole point is to educate and help all of us figure out the non-traditional retirement model of the path to real estate investing, which can really accelerate us to financial freedom. GW Capital per se, GW Capital it was created to support those in the generational wealth MD community who wanted to invest passively in real estate and still get those high, risk adjusted returns. And at this point, we're at 150 million in assets under management, over 800 units. Our goal is always, and you see this in both communities, our goal is to personalize real estate investing because it's not a one size fits all. And the point is to assist you in figuring out what your goals are, what your resources are, what your risk appetite is, and then matching that to the portfolio that you continue to build. So it's aligned with what makes sense for you. As far as, what assets we invest in, GW Capital is focused at this time on investing in multifamily in landlord-friendly states that are value add. We're not focusing on new builds. It's assets that are already either stabilized or have a little bit of a value add to bring it to stabilization. We acquire and operate them. Our goal is to provide you with sponsor and market diversification, and with the ultimate goal of accelerating your financial independence journey. GW Gives is a big part of the GW community. Our charitable mission is to empower children with disabilities in rural India. And I am very grateful for all of your trust and support because that makes our charitable mission possible. And again, 2022, Q1 2023 were periods of great growth for GW Capital. The debt market is changing. We've had historical inflation, but we're still finding great deals in great markets. And we're actually very excited about the opportunities that are coming our way. And today we're going to talk about what's, the good, the bad, and the ugly. But the point is to really talk about the real estate market fundamentals and shifts that have occurred, where we think the market is going, and how we're positioning ourselves, how we're changing our strategy and investing differently, and then also focus on asset performance, how our assets have performed in the last quarter. For those of you who are our investors, I just want to highlight this. The last email that went out had our performance report in there. When we send out the replay to this webinar, we're going to send out the performance report in it also. And so a lot of the data that's on here, you're going to have over there if you want to take a closer look at it. And then always feel free to reach out if you have any questions. Okay, let's get started, guys. So all of us know this, the big thing everyone's talking about that's creating quite a bit of chaos right now is interest rate hikes, right? We went into the pandemic, saw a period of great inflation. Over here, the CPI that tracks inflation is green, right? So we peaked at 9%, and then we've been trending down, which is great. Data that was released this month, our inflation is at 4.9%, down from the peak. So that is excellent. But what also happened is that in an attempt to control inflation, the federal government started raising the Fed fund rate. And if you can see, we're at close to 5% right now. We had another rate hike by 25 basis points recently. Honestly, the Fed has softened its approach to rate hikes. But we're also beginning to see some of the effects of those rate hikes ripple through the real estate market per se, but also the banking crisis is a consequence of financial tightening. And so we'll talk a little bit about that. But I put this graph up because I want us to keep it in perspective, right? When recently were in a super low interest rate environment. And so for anyone coming out of that, everything is relative, right? The interest rates right now can seem like they're super high, but I want us to always keep it in context. Some of you on here are, in the coaching program, and we talk more about direct ownership of real estate. Some of you are investors, but for all of us, I think it's important to remember that historically speaking, interest rates still aren't super high. And the best part is that inflation is trending down, so it is under control right now. Inflation is below the Fed funds rate, so everything is trending in the right direction. But again, the banking crisis, the collapse of SVB, Signature Bank, First Republic, they're all a direct response to high interest rates, right? And I talked about this in one of our recent newsletters, but in big part, this is because these banks were investing in low interest long-term bonds. And with the sudden interest rate hike, they then had an asset liability mismatch. And then in the social media world we live in now, there was a bank run. Account holders were withdrawing funds, leaving the banks in a negative position, right? And so every time this has happened, either the FDIC has taken over, these banks need government supports, or other banks have stepped in to take control of the situation. And so that's been happening as far as the banking sector is concerned. The interest rate hikes are also having an impact as far as multifamily is considered. So what's changed over the last quarter? Because interest rates have gone up, we've seen cap rate expansion. And all that means is that, in a sense, what we need to know as investors is that prices are dropping, right? So we have seen price correction, especially in multifamily, right? The banking instability has also meant that financing for construction is a little more constrained. And so that is not necessarily a bad thing if you're an investor in multifamily, because that the result of that is that we will be seeing lower supply entering the market, right? And so if you're looking at demand supply, that's not necessarily a bad thing if you're investing in multifamily. But overall, lending standards have gotten tighter. And there's more lending risk in the environment right now, right? So lenders are requiring multifamily owners to hold larger reserves. That can be for rate caps, but in general, some because of the higher interest rates, some multifamily deals are having difficulty with cash flow. And then some of them where if they're in a position where they may need to refinance and they don't have enough equity in those deals, with a higher interest rate environment, they may not be able to refinance, right? So there is some lending risk that we're seeing. And we're also noticing, just to be honest, right? Let's talk about the bad stuff first, right? We're also noticing rent growth's plateau. And that's not abnormal. We're at 2.5% growth, I believe, for the forecasted for 2023 overall. And that's pretty close to what it usually is. On average, rent growth matches inflation, which is about 3 to 4%. So it's not super low, but coming from the environment we were in, rent growth has plateaued, and that does affect multifamily investing. And the reason it's plateauing is because migration is slowing, the post-pandemic migration that we saw, and there's also more supply. But all of that being said, we are beginning, to be very honest, we're beginning to see initial multifamily distress. Some of you may have heard of deals that were in distress more recently. The important thing to remember is that as far as multifamily distress is concerned, there are a few categories, and I try to break it down and keep it pretty simple. There are a few categories where we're going to start seeing distress, and you're going to see it more with deals. And some of you may be invested in some of these deals. But anyways, overall, you're going to see distress in deals that have floating rate debt, which means that the interest rate is not fixed. And if they did not have a rate cap on it, their interest rates have gone up through the roof compared to when they originated those loans, which means that they may not be in a position to meet their DSCR or their debt service coverage ratio requirements. They may not be cash flowing. They may not be able to keep those deals afloat, right? So the deals with floating rate debt, but they did not have a rate cap. And then there are some deals that were originated that were acquired in 2020, 2021, where no one really anticipated interest rates hiking up so quickly, and the operators may have acquired really low fixed rate short term debt, which is due now for refinancing. And if they had high leverage, which was very common at that time, I think people are titrating more to where they have more equity in their deals going in now. But for those deals where they started off with really low short-term debt, but they had high leverage. LTV means loan to value, which means the loan is significantly large, or close 85 to sometimes 75 to 85% of the actual asset value. Those deals are likely are in a stickier position. They are going to have some distress, right? Because now they're going to have to refinance at higher rates, and they may have little to no equity in those deals just because of starting off with low equity and then a reset happening as far as multifamily pricing goes. And if then it becomes very, very hard for them to refinance, right? So that can be a sticky position. Development projects, just because of costs going up and interest rates going up, those projects can see some distress. And then I think the fourth category is there was a multifamily asset recently, operator in San Francisco. Distress localized in some pockets, maybe because of rent control, and so income staying at a certain level, but expenses rising exponentially with the high inflation that we've seen. So these are the areas where we're anticipating to see multifamily distress. And I wanted to start off by saying, okay, so this is what has changed since the last time we spoke. The banking crisis, rent growth plateauing, lending getting constrained, and beginning to see initial multifamily distress. But we're going to move on to the good stuff now. So what does that actually mean, right? What does that mean for you as a multifamily investor? And let's look at the positives, right? Fundamentally, what does the market look? What are the positive features that we're seeing, and what can we expect? How do we position ourselves strategically? So I think the most important thing to remember is that all of this is based on historical data, right? The biggest question is going to be, when do we expect rates to stabilize? And no one has a crystal ball. So I always say, forget the best case scenario, forget reasonable case scenario. What is worst case scenario, and what do we need to do to position ourselves for that? And so if you notice, this is, historically speaking, the average time from first rate hike to first cut is about 24 months, right? So we're likely going to see a cut. I mean, we may see rate cuts in 2023, but worst case, we will start seeing rate cuts in March of 2024, hopefully, right? And then when that happens, things will start easing. Property prices will be in a different cycle as far as the real estate market is concerned. Property prices will start going up again. Lending restrictions will start easing. And so the whole theme, and I've been to multiple multifamily conferences in the last few months, and the theme is, as long as you're strategic and planning as long as you have the ability to hold on to your asset till 2025, you're going to do just fine, right? Because we're going to be in the upcycle again. So that's the overall theme. And I believe that even when you look at worst case scenario, 2024 is when we're going to start seeing that pivot as far as interest rates are concerned, possibly earlier, but we want to be positioned well we want to be able to plan and, underwrite and be conservative so that we can actually see it through 2023, even if interest rates stay at this level. Now, also, as lending is getting constrained, the important thing to remember is that there's also alternate financing. There's private credit that's on the move. There are $3 trillion are waiting on the sidelines. People are waiting to invest in real estate. Fannie and Freddie Mac, the government agencies, they have $150 billion that they have allocated in 2023 for multifamily funding. So capital is available. It may not be the regional banks that we've been used to in the multifamily space, but capital is available. That's a good thing. So we're just going to see a shift essentially in how lending transitions in 2023 and 2024. Apart from that, the fundamentals for multifamily are, again, really, really strong. We talked about some of this last time. This hasn't necessarily changed because of interest rates being super high. Housing affordability is still down, which means that I think it's like rents are 37% lower than what it would be for someone to own, to buy a new property. Again, inventory is super low because people are sitting on really low interest rates. And with all of that happening, again, housing affordability is down, which increases demands for rentals. It just means that multifamily fundamentals are still strong. And there's an estimated a shortage of 4 million homes that need to hit the market by 2023 to match demand and supply. And so for another 10 years, we still continue to be in an era where we have demand supply mismatch. And a lot of this is because of construction stopping in '08 when we had the real estate crisis. Again, right now, with the way lending is, there is less financing available for new construction, for new build, and all that is again going to lead to a little bit of a crunch. So we are in a place where there is a demand supply mismatch. There isn't enough supply, and which again, it bolsters the actual underlying fundamentals for multifamily, which is a good thing. The job market is still strong, and so there's this conflicting data. But if you actually look at the numbers, unemployment rates are down. They were down. They're at 3.4% compared to 3.6 in February. So there's mixed data. There's a lot of doom and gloom if you read the headlines. But if you actually look at the data, the job market still seems strong. There were 253,000 jobs added in April alone this year. So strong fundamentals essentially for multifamily. There is a little bit of distress. There is the financing, the banking crisis that we've been seeing. Funding is constrained. All of that being said, if you look at the yield curve, which is actually the relationship of the 10-year treasury to 3-month bills, there is a yield curve inversion. And what that actually signifies is that every time there's a yield curve inversion, that's usually right before we go into recession. And as far as the recession is concerned, technically being in a recession means having 2 consecutive quarters where GDP is negative. We're really not at that point yet, but we could go into a recession. Like I said, while filtering through the data, the important thing to remember is that there's always the best case scenario, expected case scenario, worst case scenario. So worst case, we go into a recession. Most people believe it's going to be a soft, it's going to be, a shallow recession. But that being said, we're positioned to, to prepare ourselves so that we are going to come out positive and strong, even if we go into a recession. And so we've talked about this a lot. We talk about this when we talk about direct ownership. The basics, the core concepts are similar for multifamily also. How do you recession-proof your multifamily portfolio if you're investing in multifamily assets? How do you make sure you're doing your due diligence, right? So again, staying in strong landlord-friendly markets is going to be key. The market demographics is always going to be important. When we look at demographics, we look at population growth, job growth, industry diversification, right? So as long as you're investing in places where there is migration, there is industry growth, you're going to be fine. We always say landlord-friendly states just because I think one of the biggest issues we see in properties that we acquire newly is the tenant base. If you have delinquency and if you need to evict people, non-paying tenants, it's so much easier to do it when you're in a landlord-friendly market, and that does affect your bottom line. So, investing in landlord-friendly markets where you have those strong fundamentals, the demographics are favorable. That's really important. Again, this is the time where it's really hard when we're trying to underwrite deals to find deals that pencil, where we're hitting the IRRs, the metrics that we want to give our investors, but it's also very crucial, especially right now, to make sure we stay very firm in our underwriting criteria and stay very, very conservative in how we're projecting rent growths, how we're, all the assumptions we put in there, right? So that's what we're doing. We're focusing on off-market deals. We're really focusing on expanding our deal funnel so we can find the right deals, but the numbers actually make sense where we're in those strong markets, strong assets, and we're sticking to those criteria. And that's going to be really, really important. Again, market appreciation, I always say this, we're not really ever banking on market appreciation. We're definitely not banking on market appreciation right now. The goal is always going to be to find assets that are positively cash flowing. If you look at our portfolio, we're shifting towards more stabilized assets right now because they're going to cash flow from day one. And really want to stay really safe and secure in the current market. But finding properties that are cash flowing day one, finding properties where we can add value to them by doing rehabs, by improving operational efficiencies, and where we're actually seeing tax efficiencies, right? So this is true for real estate. Your returns are going to be multifold. Market appreciation is just one part of it. Prices may fluctuate, but in the long run, it's trending up. right? But what you want to look at is, okay, am I going to cash flow in this deal? What is the value add potential? Those are things that are in our control, right? What is the tax efficiency? Bonus depreciation is one way where we transfer those tax benefits to our investors. Some of our projects, I'm going to talk about this, we get tax abatements. We're able to have significantly lower property taxes when we provide affordable housing. So those are the areas that we're trying to tap into right now. Market appreciation is not in our control. We are trying to find properties that are discounted to begin with. The last two assets we acquired at a 20% discount. The Greenville asset, appraisal was 40% above what we purchased it for, right? So buying really discounted properties so that you're factoring in, those market fluctuations, but really controlling the things that we can control. I think that's really important. That's true for a direct ownership portfolio. That is true for when you invest in multifamily, right? But then the most important thing is going to be our ability to hold the asset hold till 2025. That is the theme in multifamily right now. So as long as you have debt, that is good. And we talked about those scenarios, those few scenarios where it can be a little tricky with lending and where we've got to see distress in the multifamily market. Most of the deals we've entered recently have been either deals where we've had fixed rate debt and stabilized properties where we can have agency debt. One of our assets is agency debt, which again is much safer. Having that or finding floating rate with really tight rate caps, all of that keeps us in a safe position. And having really high equity in our properties going in, that's what we've been doing. I think the last two deals, we were close to 57% loan to value, which means we had 43% equity in those deals, as opposed to operators who were entering in, say, 2020, 2021, going in with maybe 20% equity in there. We're going in with significantly more equity that's giving us the ability to hold, giving us the ability to refinance the deal if the need arises, right? But also holding on to significant cash reserves. For those of you who are in our Mesa deal and in our Greenville portfolio, distributions aren't meeting pro forma, and that's because right now, just with the way the lending environment is, we really want to make sure we're holding on to those cash reserves. So we're using those cash reserves for our business plan. So when we do rehabs, we would rather use cash in hand than go to the bank and draw and have another, and have that liability added to the property and put that strain on the property, right? So cash reserves are going to be super important. Getting the right financing is going to be super important. This is true across real estate right now. And so again, deep diving into how we are pivoting, how we're investing in multifamily. Like I mentioned, the debt that we have, we're doing a lot of fixed rate debt. If not, we're getting tight rate caps with flexible exit options. The McDonough deal that some of you are in, we have the ability in year 3 to take a look. If we feel like we should hold, we will refinance. If we feel like it's a great time to exit, we're going to hit the returns that we projected, we will exit. But having those flexible exit options is going to be really important. The McDonough deal that we got into also is an assumable, an assumable loan where we're assuming a 3.6% interest rate debt from the seller. Those are the deals that are going to be super attractive right now. So getting a little creative about financing, right? Discounted properties, like I mentioned, getting properties for 20% or more under value. That just gives you that additional buffer. Again, reduced LTV just means that we're going in with more equity in the deals. Buying newer stabilized properties is also something that we've been shifting into. You've seen that with the last two assets we brought. CapEx from equity is again what I talked about, right? With some of our assets, we are now doing partial renovations instead of doing full-blown renovations. We're actually looking to see how much ROI we're getting in terms of rent bumps, really having our finger on the pulse, shifting our strategy, not doing full-blown renovations, holding on to more cash. That does two things. It allows us to hold on to more cash till we're actually seeing those rents go up again. Once that happens, then we can go and bump up the renovations that we're doing, go to those platinum renovations, and really have a higher ROI for the amount of cash we're putting in, right? So again, staying very, very conservative when we're buying the asset, and then as we go in and execute our business plan is really important. Some of you may have, I just wanted to be upfront about what we're doing in response to the banking crisis. We have two lending partners, Truist Bank and Verabank. Verabank, we've verified they have a healthy balance sheet. And they have excellent internal risk management practices. We have contingency plans in place where we're using a service called IntraFi that breaks our deposits into 250K chunks so that they're all FDIC insured. A parallel set of accounts has been set up with Bank of America in the event that we need it. And so we're taking measures just to make sure we're doing everything on our part. Truist Bank, again, is the seventh largest bank in the United States. And so our lending partners are pretty strong. And that's a good thing. But for those of you, who haven't seen this before, and I talk about this, and I put the slide up a lot, what I want us to remember as real estate investors is that yes, the real estate prices can go up and down. The red line over here is national sales prices, right, for homes. And then this dark blue line over here is what happens to rents. But I want us to remember that plateauing rents, that does happen when we go into a period of recession. But if you look at the steep drop in home prices that happened in following the 07-08 real estate crash, you'll notice that rents really just plateaued, dipped a little bit. The numbers are actually a 5% drop in 08, 4% drop in 09 nationally before the rents started going back up. And so, and this is where it comes back to the fundamentals of real estate. Yes, it can be scary to see those fluctuations in pricing, but the important thing to remember is that as long as we have the ability to hold the asset, right? What we're looking at more is what happens to rent, right? And so if we're buying, and this is why when we're buying strong assets in strong markets, and we have a plan where we have the ability to hold longer if required, as long as they're cash flowing, and we have the ability to hold them because we have good debt on them, we should be fine, right? And which is why we stress test those deals before we go in, which is why we hold on to those cash reserves, and then we control the things that we can control. Okay, so that was all I wanted to say about the state of the market. I want to go deep down now into the actual performance of our assets. Guys, again, like I said, for those of you who just joined us, if you have any questions, feel free to drop them into the chat box. I'll have tons of time to take questions afterwards. But I want to do a quick, overview of how the assets have been performing, and then we'll get the Q&A. Okay, the Mesa portfolio, this asset has been doing great now. Despite the fact that we're coming off of the winter season, that is where typically rents cool off, and we start seeing plateauing rents. We've still had solid rent bumps in this asset. We've completed 24 partial renovations, 2 full renovations. Again, like I said, we're shifting to that partial renovation strategy because it allows us to use the cash we have on hand without really drawing from the bank, but it also, it doesn't encumber the asset with more, with a higher mortgage, right? And so we've seen average lease trade outs of $182 across both renovations on average, but that is great given that we're not even in peak summer season. That's a 27% ROI in terms of what we're getting for the amount that we're putting in for each of those renovations. So this is the average cost that we've been putting in for partial renovations. This is the platinum renovation. You can see there's a $10,000 higher cost going in if we are doing those platinum renovations. And so as we go into summer, as we start seeing rents trend up, the goal is going to be to get to more of those platinum renovations. The ROI is also significantly higher for those, but we really want to be able to see those actual rent bumps and know that the market can support it before we go in there, right? And so that's key. We're keeping a close eye on this. Delinquency, our goal is to get to below 5% over the next 2 quarters. So we're doing a great job. I think we started off at close to 20% delinquency. We're already in single digits right now, which is excellent. But the goal is to, improve this further. Occupancy, again, is great. We are at I think both communities together were close to 90% occupied. The goal, again, is to hit 95%. And we're working on this. In the first few years that we go into assets, what we're actually doing is we're executing the business plan. So we're doing our rehab. So that's when it's hardest for us to, hit those numbers. But if we can get to 95% and stay there, that's going to be excellent. And that's our target. All right. And we're really staying on top of property management to make sure that that is happening. And that's a delicate balance between raising the rents and keeping the properties occupied that we're navigating constantly. Again, like I mentioned, cash reserves are super important right now. And because of that, just because we want to use the cash reserves on hand to fund the renovations and not go in and have a CapEx draw from the bank, we have paused distributions on this asset. We're going to reassess at the end of the year. We have also paused collecting asset management and construction management fees on this deal, which adds another $180,000 to the cash buffer. The plan is to stay conservative, to really plan for worst case scenario at this point. And, when we start seeing interest rates trend downwards and rents start ticking back up, then we will have no issues with, reassessing the situation. But that's where we are right now. And that's just to stay safe. We'd rather be safe than sorry and have, to scramble for cash and funding later on. And so this is the safest thing we can do for these assets at this point. Again, income is trending up, NOI is trending up, so we're moving in the right direction. This is just to show how this is what we projected the estimate cost of rehab was going to be up to date based on the renovations we've done so far. And with the fact that we've shifted to partial renovations and really staying on top of the renovation plan per se, we've significantly lowered the cost. And so that cost saving is again super beneficial. Right now, we don't want to go into full-blown platinum renovations until we start seeing a shift in the market. But again, these are images from the renovations. I think it's a great job. I just love the way these assets are looking. And it's a strong Q1 2023 performance, everything considered. And we're just continuing to execute the business plan and monitor the economic environment overall before we make any changes to distributions with that asset. Okay, the Greenville portfolio is next. So I love these pictures. We've started renovations in the offices and the module unit has been renovated. Again, we're at the point where we're going to start doing platinum renovations on this asset. And so these are pictures from the model unit again. Great feel, a very modern look to it. And we're really hoping this is going to help us bump rent significantly. Now, this asset, when we acquired it, we got a fixed interest rate at 5%. And after we locked it in, rates bumped up to 7% over the next 2 months. So great interest rate locked in. We had 40% built-in equity because this is the asset where when we did the appraisal was 40% above what we actually purchased for the asset. So again, going in and getting those off-market deals where we're able to get those discounted deals really is the buffer that we need in this environment where market prices are fluctuating, right? But it also shows strength of the market. We've seen, again, even in unrenovated units, we're seeing rental bumps even at this time where rents have plateaued nationwide and we're just coming off of the winter season. So that's great. Again, we've completed 27 partial renovations. We're going to pivot into more platinum renovations as we get into the summer. But this is the asset. I don't know if you guys remember. I mentioned this last time. We already executed a water conservation plan. And what that does, and this is also an educational moment. This just shows you how when you either bump up your income or you lower your expenses as far as multifamily is concerned, because these assets, the value of the asset is based on the net operating income, which is the income minus expenses, essentially. What happens is that when we have a savings of $45,000, which is what we got with the water conservation strategy, at a 5 cap, which is what these assets are trading at right now, that actually means that the asset value was increased by close to $1 million, right? $900,000. And so I think this is a great point where this is how we add value to these assets, right? So it's multiple things. It's the operational stuff, it's reducing expenses, and it's going in and doing the rehab and increasing the value of the property. Okay, so that's a typo. That should say $900,000. Sorry about that. But this is also the asset where I said, and this was our plan going in, where we were going to, if we keep rent at a certain level and it's considered affordable housing, we get a tax abatement. And so that was our strategy going in. That was already in our underwriting. We just want to report that we were able to actually get the tax exemption status, which is great, which means our taxes are reduced by 61%. Again, lowering those expenses and increasing the income with the rehab and operational efficiencies, all of that is really, really, really going to significantly increase the value of this asset. Okay, rental premiums. Unrenovated units, we're still seeing rent bumps. Like I said, it may not seem like a lot of $50 rent bump, but considering the environment we're in right now with what is happening with rents nationwide, and coming off a winner, those are actually great numbers. Delinquency, we're doing a much, much better job. At takeover, we had 23% delinquency. Now, again, all of this is increasing our net operating income overall. And you may not see that in the first year. That's because we're going in, we're executing our business plan. When people, vacate, we're going and doing the rehab. So we have more occupancy because of that. So if you're looking at the numbers and you're saying, well, we're not seeing that bump up, that's because we're still in the stage where we're going in and rehabbing property. So there's more vacancy because of that. The delinquency has gone down from 23.2% to average of about 3%, and that's actually that's great. Occupancy again is at 86% and 91%. Our goal is to hit above 95% occupancy by the end of summer. The good thing is that we've seen a huge uptick in leasing activity. There's been a 46% uptick in tools, which is excellent, right? So we're looking for a really strong summer season. Like I mentioned, again, we're trying to use cash reserves as much as possible for renovations without having to go to the bank and draw from and have a capex draw over there. But that being said, investors who receive distributions, Class A investors received their prorated 7% preferred return this year, this quarter. And then Class B investors received approximately 50% of what they received in the first quarter. That's also because of trying to hold on to higher cash reserves, trying to use the cash we have on hand to do the rehabs, as opposed to go and have that extra draw from the bank. And also because we're still working on, the rehabs, increasing rents, and working on delinquency. So we're keeping a close eye on the market and also the asset, and we're going to continue to assess and make decisions about future distributions. But again, all of this data is going to be available in the performance report that is going to be attached. It was attached to the email that was sent out, the last email that was sent out today, and then the one that you're going to get with the replay. So keep an eye out for it if you want to take a closer look at those numbers. They're also in your investor portals if you want to go in and look at the detailed financials. Okay, Elevated, Eagles Landing. These are, so we had the Atlanta assets next. This was acquired end of last year. Everyone in there got 100% bonus depreciation because we made the cut. And this is a great asset, institutional quality asset, 5.3% interest rate, tight rate cap. This was an agency debt, right? So 10-year agency debt, we have the ability to hold the asset if we need to. Again, a stabilized asset, which means greater than 90% occupancy when we acquired the asset, which is why we were able to get agency debt, right? And again, it's a very safe, conservative asset with really low leverage that we got into. And those are the kind of assets that are going to be key to riding this wave, till we get to 2025. Again, 20% discount when we purchase the asset, executing the same plans, exterior renovations that are required by the lender. That's what we always start off with. The water savings plan is underway. Rental premiums, the previous owner was getting bumps of close to $400 for renovated units when they did those premium renovations, and rents were below 10% below market when we acquired. So those are all areas where we're increasing. The plan is to do the rehabs, increase rents, but also get rents up to market rents and catch up on what we call loss to lease. That's another way of increasing your net operating income and increasing the value of the property. Again, like I said, occupancy over here is close to 93%. Goal is to just keep pushing that. NOI is increasing. It's trending the right direction. Full distributions were released for everyone. These distributions are monthly distributions, so you should have received them. If anyone did not receive distributions, please contact us, admin@gwcapital.com. And ideally for this asset and the McDonough asset, if you're in there, hopefully you've linked your bank accounts to the portal, and those distributions are just getting deposited over there. Again, these assets, tons of great assets, institutional quality. Really nothing else to add over there. We're going to go in and do the rehabs. I believe 67% of the units still have the potential to get a higher level rehab, and that's the business plan. Same thing with the McDonough asset. This is an asset, and thank you for your patience. For those of you who are in this asset, some of you, this is the asset where, we got the 3.6% interest rate, but it was an assumption of a loan from the seller. And seller assumption loans, HUD loans, they can take much longer just because of the degree of paperwork required to close. And so thank you for your patience. We closed on it in March. And again, another institutional quality 250 unit asset, newer vintage, 2005 build. Again, a stabilized asset that was above 90% occupied when we got in. We got it again at a 20% discount. We're just starting our lender required repairs over there. Same thing, below market rents that we're hoping to catch up that loss to lease. And then the previous owner has proven rent bumps on those renovated units. So our business plan is to go in there and execute that. Again, distributions have gone out. The first distribution went out. Distributions are going to be monthly. And so make sure you link your bank accounts to the you have your bank accounts linked in the portal so you can get direct deposits. Again, great asset, tons of amenities. Very proud to have this in our portfolio. Downtown Atlanta is getting a $5 billion cash infusion. So all of this really adds to the value. So there's this growth happening. There's migration happening. Jobs are when you have that cash going in there, jobs are being created. All of that really positions us very, very strongly with both of those assets. Okay, wrapping up, guys. I'm going to get to all the questions. If you have questions, you can raise your hand. We have a small group here. We should be fine. But again, the question is always going to be, the question right now for most of us as investors is going to be, I have cash. Where am I going to invest it? Now, you know that in the high inflationary environment we're in, cash and bonds, they're losing value. Vanguard, this is what they put out in September 2022. Projections for over 10 years. The stock market is projected to, on average, perform at about 5% in terms of annualized returns. So what are you going to do? Real estate is still strong. We talked about the fundamentals. We talked about the distress right now, but we also talked about, due diligence, how you can really still take advantage of the strong fundamentals that exist, the supply-demand mismatch, right? The fact that we're investing in hard assets that are indexed to inflation, and we have multiple ways of generating revenue from it, right? Cash flow, tax efficiencies, value adding, where we're not really dependent on market appreciation. So it still makes absolute sense for us as investors to be investing in real estate. The fundamentals are still really, really strong. And I think the important thing to remember is that there's a lot of clickbait, a lot of doomsday scenarios being thrown out. People are afraid of sitting on the sidelines, but that's mostly individual investors, right? So individual investors are concerned, but institutional investors are very, very bullish about real estate and multifamily. And so I think that's what I want you to keep in the back of your mind. And just have this image. I saw this in another presentation, image about market cycles, right? So the real estate market cycle, and this doesn't really pertain as much to the residential space because you have really long fixed loans and you have the ability to hold those assets as long as you're making your payments. But in the commercial space, right, which is where multifamily is, typically you have market cycles, and it's called market psychology because right now we're at this point where we are on the downtrend, right? And so people are scared, people are panicking, but this is also where you have the highest opportunities, and most people wait to get back up before they consider investing in real estate, but this is where the opportunities are to be had. And so I hope that this gives you the confidence to really have an understanding what's happening, how you can protect yourself and risk mitigate, and then continue to really seize the opportunities that are coming our way. And so I like to say, don't time the market and just make sure you're positioned to take advantage of the opportunities. Guys, again, we have, for those of you who are new to our community, we have virtual events every year. The Physician Freedom Summit was last year. This year, we just finished the 10x of Financial Freedom event where we had over 2,000 physicians join us. Going to have the next one in September. I hope to see you on there. For those of you who are considering investing passively in real estate, the Savvy Passive Investors Handbook, that's a guide that I'm going to be putting out next month that you should have access to. But if you want to get on our priority investor list, please go on to generationalwealthmd.com/syndication, all lowercase. And you can get on our priority investor list to know about any upcoming deals that we have coming up in the near future. I also have a 2-part podcast called Investing in Syndication Like a Pro. If you're just starting out and a lot of this seems like it's foreign language, I highly recommend listening to that 2-part podcast episode. I go over everything that you need to know to really vet the market, the deal, and the sponsor, what questions to ask, how do you really understand the underwriting. So you're doing your own due diligence, and so you feel confident going in, right? So that's a great resource. Again, we had a ton of in-person events. I know I met a lot of you in the event we had at the wine at the Vineyard in the Bay Area. I spoke at both Best Ever in Salt Lake and at the Multifamily Wealth Project in Vegas recently. I got to see some of you over there. We're going to have more and more in-person events. I think that's a great way for the community to get together, for all of you to really form those strong connections with other investors. So you're supporting each other. And finally, I want to wrap up by saying that we're really grateful for this community because, and to our investors, because you support our charitable mission, which is GW Gives. And I just want you to feel pride in it also, because you are part of this mission. And I'm again, very, very, very grateful for the opportunity to work with all of you. Guys, you can go on to the website or send us an email at any point if you have any questions or want to get on a call with me. Always open to that.